Welcome to Breaking News at Trading Moves. Today, we're going to look at a new piece of coverage that puts the whole aerospace and defense sector into focus. We're looking at what one major bank Citi is saying about GE Aerospace, ticker GE. And what's really key here is how this one analysis sort of gives us a map for the entire A&D industry. We have all the details on the recommendations, the thinking behind them, and a specific list of companies that could benefit, and some that might face a few headwinds. Our goal is to just get you up to speed quickly on this whole market view.
Right, and the crucial idea here isn't just the one headline stock. What's really valuable for you is to understand the long-term thinking that drove this whole sector analysis in the first place.
Okay, so let's start where they did, the main event. They initiated coverage of GE Aerospace, ticker GE, with a buyer rating. That sets a pretty strong tone right from the start.
And it wasn't just a standard upgrade. The analysis really emphasizes the big change GE has gone through with its spin-offs. They believe GE Aerospace is now set up for, durable, high-margin growth. It's all about that commercial engine business and the long tail of service revenue.
And the valuation targets they put out there were definitely the attention grabber. First, an immediate price target for GE at $386. But then came the idea that really got people talking. The prediction that GE could be the first publicly traded aerospace and defense company to hit a $1 trillion market cap.
Within about 5 years, yeah.
$1 trillion.
$1 trillion. I mean, that's a stunning number in the industrial world. You're putting GE Aerospace in the same league as today's big tech companies. And if you look at how they get to that number, they're really betting on two big things. First, continued double-digit growth in that commercial aftermarket for engines. And second, just as important, that the company's valuation multiple will expand as it becomes this pure-play, high-margin business.
A call that big usually gets an immediate reaction in the market. And we saw it. GE stock moved up around 4% on the news. The analysis noted that this move pushed the stock back above its shorter-term trading averages. So you have the technicals kind of lining up with this new fundamental view. The stock's on a bit of a flat base right now, just absorbing the news.
Exactly. It shows investors got the message pretty much immediately. But like we said, the GE call is just the tip of the iceberg. It's really the result of a much bigger argument about the whole sector.
Right. The report is pretty clear that the opportunity in GE is coming from these strong tailwinds that are lifting the entire aerospace and defense complex. This isn't a short-term thing. It's about what they're calling long-cycle industry trends.
And to map that out, the analysis points to 4 specific areas that are driving this outlook. It's not just about commercial jets. They listed 1, commercial aerospace, 2, defense and government spending, 3 is shipbuilding, which is closely tied to defense, and 4 is space. That mix gives you multiple drivers that aren't all tied to the same short-term economic cycle.
And that structural view is why they didn't just stop with GE. They also issued new buy ratings for RTX, ticker RTX, and for Boeing, which is ticker BA. It really confirms that their thesis is about the whole sector, not just one company.
That's a critical point because RTX, with Pratt & Whitney and Boeing, or the other 2 main pillars of commercial air travel. By backing RTX, they're doubling down on that engine duopoly with GE.
Okay, so we've got the big picture. Now let's get into where the analysis says capital is headed. They break down the beneficiaries into 3 main groups.
The first one is jet engines and aerosystems. The thinking for these companies, the engine OEMs and systems providers, is straightforward. They control the high-margin, long-term revenue. They benefit directly from more flight hours, which means more demand for spare parts, for services, all of that. And because GE and RTX basically have a duopoly in large commercial jet engines, they have a lot of pricing power. That's the core of the thesis.
So the specific winners in this first group are GE, ticker GE, and RTX, ticker RTX. Both are perfectly positioned to capture that high-margin aftermarket business. But I have to ask, both GE and RTX have been pretty open about supply chain problems, right? Especially with engine maintenance and new builds. Did the analysis address the risk that these bottlenecks stick around?
That's a very fair question. And yes, it does touch on it. The bullish view really assumes 2 things. First, that the supply chain issues, while a headache now, are basically temporary friction in a long cycle. And second, that those constraints actually give the engine makers even more pricing power. Limited supply can mean higher margins on what they do deliver, so they're betting that the long-term pricing power wins out over the short-term production issues.
Okay, moving on to the second category of winners, aerospace parts and precision suppliers. This is a group of companies that feeds the big manufacturers. So when Boeing and Airbus and the engine makers are building more planes, these guys get a big lift. And like the engine makers, they also benefit from all those aftermarket parts orders. And that puts Honeywell International, ticker HWM, and Heiko Corporation, ticker HEI, in the winner's circle. Heiko is especially known for its replacement parts business, which is a very high margin area.
Right. And Honeywell provides all the critical avionics and components across a bunch of different platforms. Then the third category is defense tech and prime contractors. This lines up with that global rearm narrative we've been hearing about. These companies get support from ongoing defense budgets and military modernization efforts all over the world. With geopolitical tensions where they are, that government spending is pretty steady. It provides a nice defensive element to the whole thesis.
The specific winners they named here are Northrop Grumman, ticker NOC, and L3 Harris Technologies, ticker LHX. Both are major players in defense tech things like missile defense, sensors, electronic warfare, all high-priority budget items. Okay, so now for the other side of the coin. Any good sector analysis has to be balanced. So for every group of winners, there are often companies that might face some new pressures. The analysis points to three categories here as well.
The first group facing potential headwinds is the airlines. The risk here is cost pressure. This is really just the flip side of the aerospace boom. When demand for engines and airframes is strong, maintenance cost parts, labor and lease costs either stay high or go up. That can really squeeze airline margins, making them look less attractive than their suppliers.
And that risk is called out specifically for Delta Airlines, ticker DAL, and United Airlines, ticker UAL. As major carriers, they're the ones who will feel that pinch on operating costs the most.
The second category they flag is what they call lower conviction A&D names. This is a relative call. It's about capital rotation. When a big bank comes out and highlights its top picks, like GE and RTSX, you often see money managers shift funds toward those names. And that means they might shift it away from other companies in the sector, even if those companies are perfectly fine businesses.
This rotational pressure is applied specifically to Lockheed Martin, ticker LMT, and General Dynamics, ticker GD. Both are defense giants, but the view seems to be that for this cycle, investors might prefer the pure play growth of the engine companies.
Exactly. The thinking is a bit nuanced. Of course, Lockheed and General Dynamics are critical to defense. But if the main story is this commercial aftermarket boom, capital might just prefer the focused exposure you get with GE over, say, LMT's broader portfolio. So it's more of a relative underweight call, not a call that something's wrong with the company.
And finally, the third category, non-aero industrials. This points to an even wider rotation risk outside of A&D altogether. The argument is that the strong, durable cash flows from aerospace and defense leaders will attract money that might have gone to other parts of the industrial economy.
It's a powerful point about sector leadership. The analysis named Caterpillar, ticker CAT, and Deere & Company, ticker DE, as examples. Now, obviously, construction and agriculture are vital, but the view is that for this particular cycle, capital might favor the long-term growth and high margins in jets and defense over the more cyclical nature of traditional heavy equipment.
So, to just wrap up what we've gone through here, this big update on GE Aerospace gave us a lens to view the whole A&D sector. The main idea identifies three groups set to benefit from long-cycle demand.
The engine and systems makers, the specialized parts suppliers, and the defense contractors.
Right, all helped by pricing power and modernization. And on the flip side, the analysis pointed to three areas that could see some relative pressure.
The airlines facing cost issues, other A&D names that might see capital rotate away, and then traditional non-aero industrials.
So what does this all mean for you as you take in this information? Consider the long-term view that's being presented here. If the aerospace and defense sector is really at the start of a multi-year cycle of modernization and expansion, and if this prediction of a $1 trillion aerospace company actually happens, how could that kind of growth and valuation change the very structure of global industrial leadership over the next decade? That's something for you to think about as you reflect on this analysis. Please remember that the content discussed in this episode is drawn entirely from the author's opinion as presented in the material shared. This is not financial advice, nor is it a recommendation to buy or sell any security mentioned. We encourage you to do your own research.